Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. Thank you for attending this week's weekly market update. It's great to be back. I was out of town last week and Tim did an absolutely fantastic job walking everyone through the importance of both short-term and long-term financial planning, because we know that markets are going to zig and zag over the very short term. But long term, if we do our job, we do our homework, we should, if our research is executed correctly, be able to generate some decent long-term returns. But the key is getting through that short-term uncertainty, as what happened over the last few months here in the summer. But for this week's weekly market update, we're going to focus on inflation, we're going to focus on commodities, and we're going to focus on a generational shift away from traditional growth assets and toward value, and how we can make money for clients if we're paying attention and executing on long-term trend. So let's go ahead and get started. So I'm going to share my screen here. And we're calling this week's presentation Making Money Off Inflation. And what we're noticing is that while the Federal Reserve and other government officials continue to talk about this transitory inflation, it's starting to look rather sticky. Inflation's starting to dig in. And so this has a material impact as how we want to approach asset allocation. We want to invest in companies that make money and do well when prices are increasing. That's the key. People make money during inflation. Consumers are motivated to spend money and not sit on cash, because that cash is worth less every single day that we hold on to it. So there are companies that benefit tremendously over and above the rate of inflation. And our job is to figure out where those areas are and what are the companies leading the charge. So overall this week, the big takeaways is that, yes, certain stocks and sectors are overbought, but when those overbought stocks are within a long-term positive trend and we're experiencing positive breadth, that's a good thing. We want to embrace that. Amazon, Google, Netflix, those stocks have been overbought for a decade. That's what generates long-term alpha. Number two, energy and banks are continuing to lead the charge. When we look at that broadening out of value stocks, what are the sub-sector areas of leadership? That is energy, it's the banks, certain areas within the consumer class, and tech leadership continues to narrow. Yes, the NASDAQ and the technology sector is back close to highs, but the number of stocks that are participating in that rally continue to narrow. Very, very important that we nail this observation. And number three, the generational breakdown in the Japanese yen. This is where the global macro hat comes in. Japanese yen, extremely important currency. It impacts asset flows across the globe and ultimately impacts the long-term direction of interest rates in Japan, the US, and in Europe, because they're one of the biggest savers across the planet. So we're going to go through all of that today. Now, we talked about the Japanese yen. We want to lead off with it. Why? Because a lot of our call in terms of shifting out of technology and into areas of the market that exude value characteristics such as energy, financials, consumer stocks is all premised on rising interest rates. Now, what could drive a generational shift, a 30-year shift away from falling interest rates to rising interest rates? One is the Japanese yen. What we notice here is the Japanese yen started to strengthening. This is relative to the US dollar. So when the chart goes down, that means the yen's getting stronger. When the yen started to strengthen, the mid-80s Plaza Accord, what we saw was the emergence of disinflation across the globe. And what we're noticing here is that the Japanese yen over the past year, specifically the last few months, has really started to weaken. And what that could cause ultimately are rising rates in Japan, reflation in Japan, that reflation and rising rates gets exported to the US and Europe. Why? Because if rates, which are the lowest in Japan of any country, start to rise, that has a reverberating effect across the interest rate structure across global markets. So that is something we want to pay attention to. One of the most important charts of the year. What happens during reflation cycles, right? So if the Japanese yen, the reopening of the global economy leads to investors selling bonds and buying stocks, what does that mean? What happens when interest rates generally rise during a multi-year cycle? The bottom line is that value in this blue line tends to, in the dark blue line, pardon me, tends to outperform growth because it's tied to a broad strengthening of nominal global growth. Interest rates move up, growth, the distribution of growth across the economy expands, which means value outperforms growth. We don't need to pay extreme valuations for growth stocks. In other words, we can find growth in many different places. So we're willing to pay less for growth stocks and more for dirt cheap value stocks. Now, in the short term, one of the things we've talked about for a really, really long time is that, yes, the S&P 500 was only down 2%. In fact, some cases making new highs as our strategy was correcting. But under the surface, more and more stocks were correcting. And what we see here is that the S&P 500 only made about a 5% correction over the recent, past 6 weeks or so. But 88% of stocks in the S&P 500 corrected 10% or more. That kind of shows the impact of FANG, Facebook, Apple, Netflix, Google, Microsoft, Tesla. They make up close to 30% of the index. So when those stocks don't correct, the S&P 500 looks like it's really healthy, but under the surface, most stocks are correcting in a deep fashion, 10% or more. And that's really what happened over the summer. Now, those stocks are correcting, but the rest of the market has already corrected. So we need to ignore the price action of the headline indices and pay attention to the aggregate number of stocks and what they're doing. What we see here is the percentage of stocks, despite the sloppy action in the S&P 500, that are making 20-day highs has increased to 33%. That's usually the sign that the market's trying to put in some short-term bottom. Cyclicals relative to defensive. In other words, stocks that do well in a healthy economy relative to stocks that do well in a recession, again, is starting to break out to new highs. That's good for us. That's good for our stocks. That's good for value versus growth. That's what we want to pay attention to. And then, of course, to have a sustainable bull market rally, you need the market to take a breather. You need the market to take a rest. If we just go up every single day, that's unsustainable. That's what creates bubbles. So what we've seen here is, generally speaking, between 30 and 40 days, the market has entered these periods of consolidation in 2021 before inflecting higher by another 6 to 7%. 43 days in January, February, March, and then we had a 7% rise, 32-day consolidation, another 7% increase, another 32 days, and we're starting to break out of this box. And we think this is a value-led rally. Energy, banks, industrials, consumer stocks. These are the areas we want to be laser focused on. And then, of course, the seasonality. We look at the seasonality of the stock market, strong in the first half of the year, consolidates through the summer, bottoms in mid-October before rallying in Q4. Q4 is the strongest seasonal period for the stock market from a seasonal perspective. Not every year follows this, but generally speaking, Q4 is a positively seasonal time for the stock market. And then, of course, we want to focus on those old economy stocks that we talked about, those value stocks. Why? This is the chart on the right here. We see the average age of fixed assets across the US. It has hit a record high. This includes like washing machines, industrial equipment, cars, trucks, all of these, the nitty gritty of our economy is hitting a record high in terms of age. And there's only so much stuff that we can do to repair and maintain those assets until we have to eventually replace them. And we believe that we're going to enter into a huge replacement cycle. Why? Because of inflation. If you're sitting with a ton of cash as a company or a person or a consumer, and you're experiencing 4 to 5% inflation, guess what? Cash is trash. It's losing 4 to 5% of its purchasing value. It has to be put to work. I either spend it, I either invest it, or if I'm a company, I reinvest in my company in the form of capital expenditures. And so that's why we think one of our mega themes here is that after many years, we believe that capital expenditure leads to a rise in performance for value stocks versus growth stocks as companies put their excess cash to work. Second, China growth is starting to bottom. Everyone's bearish on China right now, but interest rates there, long-term rates have started to increase. Remember, long-term rates are a function of growth. Short-term rates are a function of monetary policy. When long-term rates start to go up, that is usually a function of inflation plus nominal growth. We want to see those long-term rates rise, otherwise it's a sign of deflation. Then we see industrial metals relative to gold and silver. What we see here again is that copper, zinc, those types of industrial metals are outperforming safe assets such as gold. That's what we want to see. It's a symptom of a healthy and strengthening US and global economy. And then, of course, what we want to do, it's so important to identify relative leadership. When we just look at the price action of stocks or the price action of sectors or global markets, what we can often miss some of the important shifts that are taking place under the hood. So here's a great example. The chart on the left are the financials, in other words, the banks and the insurance companies versus the technology sector. If we look at the charts, both sectors appear to be like they're hitting new highs. Looks great. But notice the difference. Within the financial sector, the relative strength of financials versus the S&P 500 is strengthening and hitting new highs. Meanwhile, in the tech sector, not only is the relative strength of tech versus the S&P 500 falling, but notice this, the percentage of stocks above the 200-day moving average continues to drop. Relative to the prior highs of technology in months past, only 73% of stocks are now above the 200-day moving average. It's deteriorating and falling even though the price action suggests strength. And that's because the companies such as Google, Netflix, Apple, Tesla, Microsoft, they're holding it okay. But the number of tech stocks that are starting to deteriorate and fall is increasing. We want to pay attention to that. And that is why we are underweight technology, by the way. So why do we like energy? Energy, quite simply, has the highest free cash flow yield in the market right now, the highest dividend yield, and has the most earnings momentum. And when we look at the technicals, the percentage of stocks in the energy sector hitting 65-day highs is rising and increasing, a sign of short-term and medium-term momentum. You need that thrust to propel stock prices higher from a technical standpoint. Look at these free cash flow yields. The sector as a whole is between 20 and 30% free cash flow yield versus tech in around 2 to 4%. That's why we love energy, in addition to some of those secular features that we love about the energy sector. We also see inventories, this yellow line, orange line, starting to plummet. This is the average inventory from a seasonal perspective. This is what's happening. And this is before today's inventory data, which reported another steep draw when the market was actually expecting a build in inventories. You also see crude oil relative to gold is starting to break out from a generational perspective. And we call this slide beware the spooky bears, right? Because, when it comes to energy, we had been bearish for over 10 years, but people fall in love with their views. And now that oil prices are going up, people say, well, energy stocks can't go higher because a rising energy price or rising oil price is going to hurt the US consumer. Not so fast. What we notice here is that, yes, We should be worried if gasoline continues to move higher. But what we notice is that the percentage change in other goods in the economy has been rising a lot faster than the price of gasoline or the price of oil. Notice this: a box of Cheerios, a Big Mac, a grande latte at Starbucks, all of those have risen double digits. In other words, 2014 to today, the price for a Big Mac has gone up 16%. A box of Cheerios has gone up 25%. A Toyota Camry has gone up 14%. Top of the line iPhone, which we all buy, up 30% since 2014. What has the price of gasoline done across the nation since 2014? Zero. Has gone up 0%. So in other words, we see here is that gasoline as a share of consumer wallet has actually gone from 3.26% all the way down to 2.35% today. In other words, oil can go up a lot more, well past $100 a barrel, before we even get close to a rising impact on the US consumer. That's an extremely important point when we're thinking about investing in asset allocation and whether or not our bullish call becomes self-destructive as it relates to the US economy. We're not even close to those points. We average $100 oil between 2010 and 2015. People forget that. And then finally, one of the things you'll notice different in the portfolio this week is we bought a home builder, a leveraged home builder ETF. Why is that? We want to have about 10% exposure to home builders for the next 6 months. Seasonally, it's what we call a rental trade. Between the months of October and March, home builders tend to dramatically outperform the market, especially when the economy is doing well. And what we see here is the months between May and October, home builders average about a 0.9% loss. But if you buy the stocks in mid-October and let them ride until March, they average about a 17.1% gain over the last 12 years. So that's something that we're playing here over the very short term. It's a small position, but it's something that we want to pay attention to, because when we get this seasonality trade plus the reopen, that's really good for autos, it's good for trucks, and it's good for home builders. And we're playing it through autos, Ford and GM, and of course, through the home builder ETF. That's a rental. We'll eventually sell that if the trade works out and rotate that into other areas of the market. And of course, credit remains intact. We see no risk in the credit markets right now, acting absolutely beautifully despite some of the volatility over the last 4 to 6 weeks. So overall, our conviction level on value leadership and commodities making that generational shift away from growth is increasing. The shift to value, we believe, based on our research made last years, not months, energy and financials are leading the charge, and a weakening Japanese yen may accelerate this shift. So as usual, please reach out to your advisor if you have any questions, concerns, follow-up from this presentation. We're more than happy to help. And as usual, have an absolutely fantastic weekend, and we'll speak again next week.